very important topic, very essential topic that anyone should know, the monetary system. Okay, so today we'll be like discussing about how money works, and then how banks work, and then how the lending system of banks work, and how do they calculate this reserve ratio and leverage ratio, and many more. Okay, so I guess it's going to be very interesting for you. So this with this you can able to understand how the world economy works, and then I guess this is going to be very useful for you in your future. Okay, so let's see what money is and why it is important for anyone. Okay, let's imagine a world without money. What would happen, right? So if we would be like obviously needing things, we would be trading, but we would be like doing a barter system. So imagine I want to buy rice, but I have wheat. So I might give wheat and then get rice. But the person on the other side who's selling the commodity is not interested in buying what I have. What will happen? So I might have to look into an intermediate commodity where my seller would be interested in. So I might go for another transaction, and sometimes you might have to get into a lot of intermediary transaction. That's obviously gonna make my life difficult. So thanks to the existence of money. Okay, so actually this actually make people life better, and then it also like make people to get what they really want with whatever they have. Okay, so I guess like yes, our lives will be like very difficult if we don't have this concept of money. Okay, yes, but it was kind of totally different earlier. The money was different. I mean, we had gold, silver coins, and then we were using some grains as a common money. But things have changed, obviously. But still, different countries follow different currencies, and we have foreign exchange also in place. So when you are in India, and then when you travel to UK or US, yes, you obviously have to use a different currency, but still we can exchange thanks to the existence of all the money transfer and foreign exchange firms. Otherwise, it will be really difficult for us, right? Okay. So what are these functions of money? It's a medium of exchange. So it actually acts as an item where a buyer can give it to a seller to buy what they really want. Okay, so it is a unit of account. I mean, it's an yardstick that people use to measure the price of the product, or it's an yardstick to measure your debts, or it's an yardstick to measure your income, right? So we measure everything in terms of money. So imagine you want to buy a house. How do you measure it? We measure it based on the value of it in terms of money. If you have a house in India, it is like measured in terms of rupees. If the house is in US, it is measured in terms of USD. If the same is in Australia, it is measured in terms of AUD, right? So it stores value. Okay, it helps the people to use it when they want to like transfer by doing it. They were able to like transfer the purchasing power from present to the future. Okay, you can store it. See, imagine I can like able to store 1 lakh rupees in my bank account, and then I'll be able to like use it in the future. Yes, it's possible. Yes, we have inflation, deflation, but still, if we think we have the same inflation rate over next 10 years, yes, I can store it. Okay. So there are two different kinds of money. First one is commodity money. So it actually the money which never lose its value. Okay, even if you like take the concept of money, it will be valued in the with it with which has its own value. So example, gold coins. I mean, we are not assigning any number to it with respect to the foreign exchange or something. So here you have 10 grams of gold. Yes, it is valued to some amount of money. Whereas the other one is fiat money. Here it doesn't have any intrinsic value, but we just like use it as a concept of money because the government says it. But this gold is it's not like that. Even the prices of gold doesn't have any or relationship with the uh, government. So the government and the price of gold, I mean, they don't go together. But the price, the currency and the government, I mean, it goes together. Government only dictates the currency value, right? Okay. Next one is money supply. Okay. So I mean, how is money supplied in the in economy? Okay. So I mean, it is kind of like supplied in two ways. First one is through currency. I mean, the paper money or the coins that we have, as and as deposits, demand deposits. I mean, sometimes we deposit the money we have in the bank accounts, and we access it based on our need, by just going to a bank, writing a check, or using a debit card or credit card, right? So we have two different kinds of money supply. Okay, either you have it in your pocket, or you can like have it as a balance in your bank account. Okay, so this is a money supply or a money stock. Okay, it's nothing but how much money that you have in an economy. So the big candidates have it as either in their pocket, or they have it in their bank balance. Okay, so we there are like few problems that governments and individuals face when controlling the money supply. Okay, so what if, let's take an example. We store money only in this two areas. We either have it in a pocket or store it to the banks. Let's imagine there is no concept of black money. No. Okay. So if the households like hold more money and they don't like deposit much money in the banks, so the bank will not be able to like provide loans. I mean, how do the bank will provide loans? All the common man go and deposit their money in the bank. So with that money, the banks is kind of providing loans, lending loans as a home loan or education loan or a vehicle loan, and many more. Right? That's how the bank works. So if nobody's kind of going and like depositing the money in the banks will not have enough reserves. The money they hold, reserves is nothing but the money they hold. So they'll be having very fewer reserves. So with fewer reserves, they'll be making only very few loans. So the money supply will go down because the circulation of money in the country will go down. Okay. In another scenario, everybody is like going and depositing the money in the bank. Okay, so they have a lot of reserves, but they are not willing to provide any loans. They're keeping it with themselves. That's what this Indian national banks were doing in the olden days. They were making very, very fewer loans. They're not very open to like provide loans. It was very difficult in the olden days to get loan in the banks when compared to the current days. If you talk to your grandfather and parents, you would know that. Right now, you get a call from different banks asking, okay, do you need loans? But that's not the case. The olden days, you have to like walk to the banks many times with all your docs, yet still you don't get a loan. Okay, so during that time, the money supply will fall. Okay, but if the government can compensate for household and bank behavior to retain fairly precise control over the money supply. Okay, so if we have both the conditions, the first and second one, there's going to be a lot of trouble in the economy. People will suffer, right? Even if the people are not depositing money in the bank, or even if they deposit, the bank is not lending, who's going to suffer? Bank is not going to suffer. They're going to operate. They're going to have the money, right? They will just operate with limited money they have, or they can have more money. They just like have it in their lockers, and then they'll just be there. That's what Indian banks were doing for a long time, But when the government comes in, and they were able to control how banks should work, they can actually control the money supply. So that's what all the governments are doing right now. Okay. So I'm talking about what happened in US in during the 1930s. I mean, you should have all heard about the Great Economic Depression in US in around the 1930s. So at that time, there's a lot of banks were kind of closing, and the money supply was kind of falling to 28%. Okay, so this actually led to the Great Depression in US. Okay, so since then the government realized how they should be running the banks, and they started intervening. Okay, so things have kind of changed. In even in UK, one of a bank called Northern Rock Bank. I mean, they were experiencing, insolvency, and the British government came in and then pumped up some amount, and they were able to get back in track. And there is a lot of some rumors, even was ICICI government, ICICI Bank was also like was in the stage of going bankrupt, and then government has helped in like uh, in coming over that. Over it happened like in a few years back, and because it was too big to fail, that's what it's being rumored, but I'm not sure if it's true or not. Okay, so let's not talk about that. I mean, let's talk about what's the concrete examples which is like being published everywhere. Okay, so most of the people believe the Great Depression in the US in 1930s, it's because of the inefficient working of the banks. Okay, let's talk about how the bank reserve should be working. Okay, so throughout the globe right now, the banks have a fractional reserving banking system, which means uh, they're not supposed to like have all the deposits they have as a reserve. They're supposed to like give it as a loan when lend as a loan when people were asking for it, but they should not be like lending everything what they have. Okay, they should be keeping a fraction of deposits as reserves and have the rest to provide loans. Okay, so let's see. I mean, let's see. Let's assume we'll be going to having 10% as a reserve. We're going to keep only 10% of the deposits as a reserve, and the rest of them we're going to lend. Okay, so this reserves fractional reserve ratio will be like differ from country to country and from time to time. I think you should be like, if you are like watching news, economics news, financial news over a period of time, you might say, okay, the Reserve Bank governor kind of increased the reserve ratio, or this time the government is decreasing the reserve ratio, right? So we might not know what is it. Okay, it's actually for banks. Okay, if the reserve ratio is kind of getting higher, you may not get bank loans easily, but if the reserve ratio is getting lower, you will be able to get bank loans easily. So it's don't always offend your banks or bank managers for not giving you loans. It's actually based on the government, okay, and the Reserve Bank policies. Okay, so the government actually like established regulations on how much amount of reserves that any bank should be holding. Okay, so the bank can like hold a reserve which is more than what the government is saying. Okay, but they can't like go beyond. So actually it gives us a minimum amount of reserves. For example, the government says 10% of reserves should be like hold it back, so you can hold 10, 12%, 15%, 20%, but you can't hold only 8%. Okay, you can't just go below the minimum number. So reserve ratio is nothing but a fraction of deposits that a bank hold as a reserve. Okay, it's total reserves as a percentage of total deposits. Okay, so now we're going to look into the bank T account. Bank T account is nothing but accounting statement for bank. Okay, when you say accounting statement, it shows your assets and liabilities. I mean, everybody has this accounting statement. Okay, it's called in. It's been like used by all the firms. They call it as a balance sheet. So they have the list of all the assets and the list of all the liabilities. Okay, since it is a bank, deposits becomes liabilities. For example, for a firm, the capital, I mean, and the building, raw materials, everything becomes assets. Liabilities is the bank loan or the money they borrowed from the friends. Whatever that they want to pay becomes the liabilities, and whatever that they own becomes assets. Whereas for a bank, deposits is a liabilities because people have, I mean, common man has gave it to the bank, so that becomes a liability because they have to give it back. Okay, here the reserves and loans they lend. Okay, reserves what they hold, and because they already have it right now with them, and loans is like what they give. So people will give back the loans to them because we have to like pay our EMI, right? So that becomes the assets. Okay, so always the sum of assets should be equal to sum of liabilities, either for a bank balance sheet or for a company's balance sheet. Sum of assets should be always equal to the sum of liabilities. Okay, so here the bank's liabilities includes the deposits and assets includes the loans and reserves. Okay, and here the reserve ratio is 10% because we have 10% of $100. So we have imagined we have only like the $100 in the bank where people have deposited, and then we have holded like $10 with us, and then lended $90. Okay, so 10 plus 90 is 100, so deposits is 100. Okay, so reserve ratio is 10%, which is like mandated by the government. Okay, let's get in with this knowledge. Let's get into an example where we have three scenarios. Okay, so in the first scenario, we'll be like looking at what happens if there is no banking system at all. There's no banks at all throughout the whole world. The second example would be like 100% reserve banking system where bank has all the money that they have as deposits as reserves. They're not giving any loans. And third one is a fractional reserve banking system. Like what happens if the bank is like lending money to people by just having very few money as their reserve. Let's see all this. Okay, first one, no banking system. Okay, so imagine the whole economy, everybody in the economy has money, and then when they sum all the money that they have, it comes up to only $100. Okay, so they'll be like that just like gets circulated within the economy. Imagine there are like only 10 people living in the country, and each of them have $10, and then they just like go and buy products and then give their money. So imagine I have only $10 and then I want to buy rice, which cost $1 for kg. So I gave $1 and bought 1 kg of rice from someone. So that person gained $11. And then if he wants, cell phone, I'm making cell phones, and I sell it for $4, and then he buys cell phone from me, and then what happens? I gain $4, and he'll be using $4, leading to his money value to $7, but I'll be having $13. So when this happens, so yes, the money will be circulated, but there's no chance of anyone earning more, everybody earning more money, right? So this would be the situation. In the case two, in 100% reserve banks system. So whatever that the money have, they have everybody has like deposited in the bank, and the bank is kind of keeping it everything in the reserve. They're not like lending it to anybody. So when I want it, I can just go and write a check and get it back, or I can just use my debit card or debit card. Because credit card is not allowed because it's not providing any loans. So what will happen? Here the money supply becomes only $100, right? Because if I want, I'll instead of keeping it with me in my earlier scenario, I gained $13, right, by selling a cell phone to my neighbor. So I got $13. I just go on deposit $13 in my account, and if I want, I'll just go on use it. So here it just been the banks have been only acting as the lockers. Okay, they are not doing anything else in the 100% reserve banking system. Okay, so here the banks not affect the size of money supply, and even earlier the banks did not even exist. But here the existence of banks doesn't make much difference because it's not affecting the money supply. In my third case, fractional reserve banking system. Okay, imagine we have a reserve ratio is 10%. Okay, so people can able to get loans apart from the 10% of the reserves, apart from the 10% of the deposits the bank has. Okay, so here the people will be able to get $90 as a loan. Okay, so the money supply becomes $90 plus the $100. People already have $100, and the people who don't have money has a possibility of getting $90. So in the economy, in the country, in the society, people will be having a chance of getting $190. Okay, here the bank doesn't create money, but they have created the money supply. Okay, so here it's not creating money. Please understand that. Okay, so here the borrowers gets $90, and then which gets accounted to in the money supply. But there's a new debt also. So imagine I want to like start a new company, and then I want $90, and then I just go on like get the money in the from the bank and I'm building a factory, and the people who's working for me as in building the factory, I'll be paying them wages through that, and then I'll be like buying raw materials. So imagine this money gets like spread out, right? So here, sorry, here the bank is creating money but not the wealth. Okay, so, sorry about the earlier thing. So here the bank is creating money but not creating the wealth, because it doesn't own people. See, I just got the money, $90. Okay, the bank created the money for me, but I have to pay it back. I'm a borrower, right? Even the bank is a borrower because he got it from the depositor. The bank got it from the depositor. Okay. Okay. So imagine I'm a borrower, and then I got the money as loan from the bank A, and then I've deposited my $90 loan in another bank for transaction. Okay, so imagine I got a loan from Swiss Bank of $90, and then for easy transaction I deposited my money in one of the national bank in India, so that I can just make the transaction very easy. I can just issue checkbook or just swipe a debit card, because the transactions become easier. So I deposit the money in my local bank. So what these people do? Okay, so here I've deposited this $90 in my second in the local bank here. So they also have a reserve ratio of 10%. Okay, so which means 10% of $90 is $9. They're keeping a reserve of $9, and then they're lending that money as a loan of $81. Okay, so there's someone else, maybe Vishnu. Vishnu is trying to get a loan from the Second National Bank from the money which I have deposited. Okay, he gets the money as a loan and then deposit it in some other bank. Okay, what will happen? So that becomes a liability for the third bank, and then that will keep it in the reserve. So imagine they are keeping 10% as a reserve and then lending the rest of them. So here it becomes $72.9. Okay, and this kind of continues. Okay, so it not necessarily that I'm doing this, I'm depositing in another bank for operations. So it can be like I got a loan from Swiss bank and to make a factory, to create a factory. Then I'm doing well in my business, I was able to generate more money, and but I'm just like keeping my transaction in my local bank. Okay, I'm making more money, but I'm not willing to like pay the loan immediately, but I'm just like paying my EMI because I want more cash flows. So if everybody thinks like that, though I have more money, I don't want to pay my loans, but I'm not like not planning to like escape from paying my bank loans, but I'm just paying every monthly EMIs. So if I do that, the banks are getting benefited as well as the rest of the borrowers also getting benefited, and this chain goes on. Imagine what will happen over a period of time when this kind of happening. So initially it was $100, and then it becomes First National Bank lending $90 and $81, $72, and it was kind of going on, and finally it might reach $1,000 at the end over a period of time when you sum up everything. Okay. So here this $100 of reserves have generated $1,000 of money. Okay, so here the banks have created money but not the wealth. They have a debt. Everybody who has like got the loans have a debt. All these banks have a debt to their depositors. But with just $100, they were able to create a money of $1,000, but they've not created wealth. Okay, so we have a concept called money multiplier here. So it's actually a reverse of your reserve ratio. So when you have your reserve ratio as 10%, okay, so 1 by R is your money multiplier. Okay, so with that we can say $100 of reserves creates $1,000 of money. So with you can say like 10% of $1,000 is 100. Okay, with that we just like came with this number. So let's get into a real balance sheet. So we were just been talking only about liabilities and assets with just deposits and loans and reserves, but there are a lot many others. Okay, so let's see like what are things that comes in the realistic balance sheet right now. Just have a good understanding on this, but we'll be like looking into an example also. So just like understand the words that will be like used. First one is assets, and that's what we saw. I mean, besides your reserves and loans, bank also will be having securities. Okay, so they'll be like issuing securities as well. If you are like following the stock markets, you'll be able to understand what are securities. So next one is like liabilities. So we in liabilities we just like had deposits, right? But apart from that, we might be having equity as well as debt. Okay, so when the owner invest money in the bank. Yeah, most of the times we have nationalized banks. As when the government puts in money, we call that as bank capital. Or when we have private banks, we have ICICI, HDFC, and KVB. These are private banks. When the the founder of the banks like puts in some money initially, that is called as a bank capital. Okay, it's actually it's obtained by issuing equity to its owners. Okay, so you will able to get this number by applying the formula assets minus liabilities. Okay, so whatever they don't, if they have more assets, it will be like if the bank is able to create more money to its owner, we can call that as a bank capital. The capital requirement is nothing but a government regulation that specifies a minimum amount of capital. I mean, sometimes if the government might say the bank, every bank should have at least 20% of the money as a bank capital. Okay, which means all their earnings will go in there. All the bank earnings will go in there. Okay, so leverage is nothing but use of borrowed funds to supplement existing funds. So how they were able to like make loans or like make investments with the deposits that the people have made. Okay, so this is how the more realistic balance sheet looks like. In the liabilities, we have deposits which the common man has like made in the bank, and the debt of the bank. So yes, sometimes the banks borrow money from the Reserve Bank, or sometimes they borrow money from some of the businesses to make it functional. They borrow money from the government. Okay, and the capital is the money which is like kind of invested by the founder, or the profits, whatever profits that a bank has made will be like added to the capital. Okay, and reserves are nothing but the money that the bank holds. Loans is the money that has been lent to the borrower, and securities is the one that is kind of like invested in the stock markets. Okay, so leverage ratio is nothing but the ratio of assets to the bank capital. The ratio of assets to the bank capital. Okay, So will we just like calculate what is the ratio here. Okay, so here the assets is $1,000 and the capital is $50. So 1,000 divided by 50 is 20. So here the leverage ratio is 20. Okay, which means for every $20 in the assets, the bank owns only $1, and rest of the $19 is financed by the borrowed money. So if the bank has more capital, which means the bank is doing good. If the bank is kind of financing all their assets with the money that they borrowed from the government or a reserve bank or from the deposits they have, we can call that as a I mean they don't have enough capital with them. Okay, so the interest if they gain more money from or interest from these assets, that will get accumulated into the capital. So we'll see that in an example here, how this leverage affects the profits and losses. Here, if a bank assets were able to like appreciate by 5%, which means I've invested in stock market. Okay, and then the bank has invested in securities, and then with that maybe my assets kind of like appreciated by 5%. So which means my assets becomes $1,050. Okay, so which means my bank capital goes from $50 to $100 because I earned money by the bank earned money by investing um, in the stock market. But they have not invested their money. They have invested the deposited money from the common man, right? But they have invested in the stock market, but they have earned money. So that has doubled the owner's equity. So here, this $50 becomes $100. Okay, so with securities, they have like earned $150. This $50 will go in here to the capital. Okay, so but if the bank assets decrease, if the bank loans money, okay, what happens? This bank capital falls from $50 to $0. Neither the borrower's money, I mean, neither the depositor's money get like affected by the loss or the profits. Only the bank capital gets affected. Okay, here if the assets decrease, bank capital goes by goes to $0. So sometimes if people who got loans, they're not willing to repay it, what will happen? It will affect the bank capital only. It will not affect the depositor's money. Okay. So if the bank assets decrease more than 5%, here the leverage ratio was only 20%, right? It's fine. $20. Okay, so if the bank assets decrease more than 5%, what will happen? The bank solvency, I mean, bank capital will be negative and the bank will go insolvent, which means the bank doesn't have enough money to operate. Okay, so it will be negative. So this is where, when the bank declares insolvency, this is where the bank gets closed, and then governments will come in, pump in more money, and then help the banks to recover. So this is what happened in the economic depression in 2008 too, and there was a recession, right? This is what happened in US banks. Okay, so yeah, let's talk about this, the financial crisis of 2008 and 9. What happened here? So here the banks suffered a lot of losses because of the mortgage loans. So a lot of people, they mortgaged and then they got loan. For example, mostly it happened because of the home loans. In US law, everybody started buying homes, and then there was a house bubble, house price bubble, which means the prices of houses was kind of increasing tremendously. Imagine there's a house which was like valued only for like $5 lakh, but in the market it was like kind of sold for eight lakh dollars, $10 lakh. There was a house price bubble. Because there's a lot of demand, the price kept on increasing, and because of that, the bank started valuing the prices also in the bubbled rates. Okay, so with that, banks start financing the homes. So when we just get a home loan to buy a home, it actually gets registered in the name of the bank. You don't get, I mean, you when you like finish all your EMI, it get registered to you in your name back. But initially it get registered in the bank's name, right? So so because of this mortgage loans, what happened, the when the money houses price kind of started falling because there was less demand. What happened? And people were also not able to pay back their loans. So there was a bad lot of bad debts, and then um, the assets starts decreasing, and because of that the bank capital was also started decreasing, and the banks uh, was coming into the insolvency one by one. So, so many banks becomes insolvent from 2000 to 2007 in US. Like almost 27 banks failed. In the period between 2008 and 2009, 166 banks failed because of this house bubble crisis. So it's mainly because of this mortgage loans. Okay, so even like other banks were also like in the verge of failing because they were lending more and people were not able to repay their loan back, and there was a lot of credit crunch. So what the government did, they pumped money to all these banks. Okay? The US government pumped lots of money, hundreds and billions of dollars into the banking system from the taxpayers' money, and then it helps them restore their bank so that they will be able to return to the normal level. So over like 2009 and 2010, the banks kind of like coming back to normal, and they were able to lend again, but with very careful note. Okay, yeah. So that's what happened. I think it's a good story about what happened from the beginning until 2010. Hope you are able to like understand about what we are discussing. So we discussed about what is money, what how do money works, different kinds of money, functions of money, and how banks work. I mean, how the bank statement looks with assets and liabilities, and we discussed about three cases. Uh, what if there is no banks? What if there is a bank but they don't lend money? And the other scenario, what if they have 10% of reserve system, and how it can like able to create money but not wealth? And then what happened to the 2008 financial crisis in US? I guess you all had a good understanding on this. If you got any questions, you can just let me know.